Everyone, good day to you. Okay, today we're gonna see how to calculate the value of the stock or how to do the stock valuation. Stock, shares, and equity more or less have the same meanings, okay? And why do we need to do such a thing? Why do we need to calculate the value of the stock? Is that okay? Okay, the time that we want to buy a share, we need to compare actually the intrinsic value, the actual value of the share with the market price, okay? But how to find the intrinsic value or the real value, actual value of the stock or share, then we need to follow a few concepts and methodology and formulas in order to find the actual value. And after finding the actual value, then we compare it with the market price that either we're gonna buy it, we're gonna sell if you're holding the share, or if you're holding, we're gonna keep it. Then depends that if the intrinsic value is higher or lesser or equal to the market price. Learning objectives. Explain the basic characteristic of common stock, define the primary market and the secondary market, calculate the value of a stock, given a story of dividend payments, explain the shortcomings of dividend pricing models, calculate the price of preferred stock, understand the concept of efficient markets. Okay, let's see the characteristic of common stock. Major financing vehicle for corporations means that if the company needs fund, how can they raise fund? There are few ways that they can raise fund. If the company goes public, then they can issue shares, which is called IPO actually. And this is one way of raising fund. And of course, there are other ways. If they can issue bonds or they can get loan or some other stuff, crowdfunding. But in this particular case, we are referring to the common stock. Major financing vehicle for corporations. Provides holders with an opportunity to share in the future cash flows of the issuer. Okay, when we buy a stock or share, there is two ways that we can, as a shareholder, we can be benefited. When a company makes some profit, a profit after tax or some earnings, then the company can share those profits with its shareholders or keep it in the company. If the company shared those profits with its shareholders, it is called dividend. Okay, this is as an income, this is considered as an income for the shareholder. This is one way the shareholders can be benefited. Other than that, if you buy the share, for example, $10, and later the price goes up to $12, then there is $2 capital gains. Okay, capital gains is one way and dividend is another way that the shareholders can be benefited. But on the other hand, not necessarily the company gonna pay dividend, okay? It means that if the company doesn't pay dividend, then the shareholders will be just benefited by the capital gains. Hopefully the price gonna go higher than the price that they already bought the share. Otherwise, if the price drops below the price that they bought the share, then this is considered loss. Okay, holder have ownership in the company. Of course, you are the shareholder of the company. Unlike bonds, no maturity date and variable periodic income. Ownership. Share in the residual profits of the company, which already I explained it. Claim to all its assets and cash flow once the creditors, employees, suppliers, and taxes are paid off. What does this mean? It means that if there is a profit, then the company first supposed to pay the creditors, suppliers, employees, and of course the tax. And if there's anything extra, then gonna go to the shareholders. The same story in times of liquidation or the bankruptcy, creditors, employees, suppliers would be paid first. If there's anything remain, then gonna go to the shareholders. How about the voting rights? Participants participate in the management of the company. It means that shareholders will elect the board of directors in the AGM, annual general meeting. And the board of directors gonna elect the CEO of the company. And elect the board of directors, which selects the management team that runs the company's day-to-day operation. Claim on asset and cash flow, residual claim. In case of liquidation, it means that if there is the hostile takeover, if there is a bankruptcy, or when they want to just sell off the company, then shareholders have a claim on the residual assets and cash flow of the company, known as residual right. It means that creditors, suppliers, employees, everyone should be paid first. The residual, the remaining, gonna go to the shareholders. Vote, voice in management. Standard voting rights. Typically, one vote per share provided to shareholders to vote in board election and other key changes to the charter and bylaws. Can be altered by issuing several classes of stock, non-voting stock, and super voting rights. Non-voting stock, which is usually for a temporary period of time. Super voting rights, which provides the holders with multiple votes per share, increasing their influence and control over the company. That can happen in the family businesses and the pyramid structure. No maturity date. Considered to be permanent financing, infinite life. For example, no maturity date. No promise date when investment is written. What does that mean? It means that as long as the company is performing, functioning, and as long as the company is public, if you buy the share, then you are considered as the shareholder. No fixed or maturity time for the share. Dividends and their tax effect. The companies pay cash dividends periodically, usually every quarter, to their shareholders out of net income. I already explained this part for you. Unlike coupon interest paid on bonds, dividends cannot be treated as a tax-deductible expenses by the company. Okay, when you receive, as a shareholder, when you receive dividend, then it is considered income and you're supposed to pay tax over that dividends. For the recipients, however, dividends are considered to be taxable income. Okay, authorized issues and outstanding shares. We need to know the definition of these particular terminologies and the concepts. Authorized shares, maximum number of shares that the company may sell as per charter. Issued shares could be categorized in two categories. The number of shares that has already been sold by the company and are either currently available for public trading, which is called outstanding shares, or held by the company for future uses, such as rewarding employees, which is called treasury stock. Okay, what is treasury stock? Non-dividend paying means that if you are granted the treasury stock and those stocks not going to receive any dividends. Non-voting shares being held by the issuing firm right from the time they were first issued, or shares that have been later repurchased by the issuing firm in the market. What is repurchase means that, for example, a company says that, okay, the number of the shares that is outstanding is too much. Then they want to reduce the number of the shares in the secondary market. They buy back or repurchase their shares. When they repurchase their shares, that share is considered as the treasury stock. Preemptive rights, or simply they call it rights. Privileges that allow current shareholders to buy a fixed percentage of all future issues before they are offered to the public. Means that these shares are first offered to the existing shareholders. Enables current common stockholders to maintain their proportional ownership in the company. Okay, stock markets. Stocks are traded in two types of market, primary market and the secondary market. Or they call it first sale and after sale. Okay, what is primary markets? First issue market where issuing firm is involved. Initial public offerings, prospective, due diligence, firm commitment, and best efforts. What is IPO, initial public offering? When the company goes public, wants to be listed, then they need to issue shares, isn't it? For the first time that the company is issuing shares, it is called IPO. And it is traded in the primary market, means the company sells it to the shareholders, the first-hand shareholders. Okay. What is prospective due diligence and firm commitment and the best efforts? Let's see. Initial public offering is the first public equity issue of a firm. Prospectus is a document that provides information regarding the issuing company and the impending sale of securities to potential buyers. Means that when the company is going IPO, then they need to release all the information related to the company, which that booklet is called prospectus. Due diligence, step undertaken by an investment banker to ensure that all relevant information regarding the stock issue is being disclosed prior to the sale. It means that when the company wants to go for the public, they cannot just simply go by themselves. They need other institutions or organizations help them. One of the entities that is involved in the IPO is called investment bankers or investment bank. They can do the underwriting. Firm commitment is an underwriting arrangement under which the issuing company is assured of getting a fixed amount of funding, since the investment banker essentially buys the entire stock issue from the company at an agreed upon price and then tries to sell the issues for a higher price. It means that the investment bank buys all the shares from the company at a lower price and later the investment bank sells it to the shareholders at a higher price. Best efforts is an arrangement whereby the investment banker pledges to give his or her best in trying to sell the shares in exchange for a small commission based on the selling price of the stock. It means that the investment bank gonna help the issuer, the company, to sell off its share and gonna get some commissions. Secondary markets, how stocks trade. A forum where common stocks can be traded among investors themselves. It means that after the IPO, shareholders can trade the shares among themselves. But how they gonna do that? They need to go through the intermediaries or a third party, which is called stock exchange. But why do we need to have the secondary markets? What do they do and what's the role of the stock exchange? They can provide the liquidity. What is liquidity? It means that if you want to buy and sell any shares, where you gonna go? Who's gonna give you the buy price or the sell price? And that is the role of some of these stock exchanges and the investment banks that to provide liquidity. In the United States, three well-known secondary stock markets are New York Stock Exchange, Amex, Nasdaq. Which under each of these, we're gonna have a specialist, ask price, bid price, and bid and ask spread. Who is a specialist? A specialist is an elite member of a stock exchange assigned with the exclusive responsibility of maintaining an orderly market for an assigned group of stocks for which he or she keeps records of unfilled orders, awaiting execution in the limit order book. Means he is the person in charge for sets of stocks. And in a way that the specialist, he knows everything about those particular stocks. And if there is any orders gonna go through this particular specialist. Ask price is a price that the dealer is willing to sell at, or is a price that they ask to sell it to you. Bid price is the price that the dealer is willing to buy at. It means that always the ask price is higher than the bid price. And the spread or the bid ask spread is the dealer's profit or difference between the bid price, the buy price, and the sell price. Which whenever we buy any stock, we are losing the spread. Bull markets and bear markets. When the market starts to go up, the prices in general, the prices in the market start to go up, it's called bull markets. And when the prices start to drop, it is called bear markets. Okay, now we're gonna do the stock valuation. We're gonna get into the calculation. Okay, value of share of stock. How to find the intrinsic value of the stock means that this is the present value of its expected future cash flow. Okay, what are the expected future cash flow of the stock? So when you buy the stock, of course, you expect to get dividends, and at the end, you're gonna sell it off, isn't it? Then we're gonna bring back all this dividend to the present time, discount back plus this price, the selling price, we're gonna discount it back to the present time, then we can find the price of the stock or intrinsic value of the stock or the price that we're supposed to buy actually. And of course, no guaranteed cash flow information that maybe the company gonna pay dividend, not gonna pay dividend, and even we don't know how much we can sell the stock. And no maturity date, of course, we can keep the stock as long as we wish to. And valuation is more an art than a science. And here is comparing the characteristic of the bonds and stock, which we already have gone through. Okay, the dividend discount model. Most of the models that we're gonna refer at this lecture talks about the dividend, okay? But there are also some other models that are not referring to the dividend. Why? The thing is that not necessarily company is gonna pay dividend. Then if the company is not paying dividend, then how to find the value of the share of that particular company? It means that there are some other models that can help us to find the value of the shares. Okay, a 1 year investor, potential cash flows. See, if you want to buy the share, first of all, how much you're supposed to pay for this share? How you're gonna find the intrinsic value? We refer to the dividend which we're gonna receive after a period of time. For example, in this case, we assume after a year, and also we're gonna sell the stock at this price. Okay, timeline for 1 year investor. The cash flows are risky, we must discount them at the equity cost of capital or required rate of a return. Okay. The dividend discount model, where do we get this formula actually? Okay, how to find the return on any investment is the price that we already bought minus the price that we're gonna sell. If there is any extra income, which in this case we assume that there is a dividend plus extra income dividend, divide by the price that we're gonna the price that we already bought. Then okay, this could be the required rate of a return of any asset, or in this case we call it R of equity. Okay, when we rearrange it, it would be like this, which, okay, by plugging in these numbers here, we can find the intrinsic value of the stock. If the current stock price were less than this amount, expect investor to rush in and buy it, driving up the stock price. It means that we compare this price with the market price. Then we're gonna decide whether to buy, sell, or hold the shares. If the stock price exceeded this amount, selling it would cause the stock price to quickly fall. Okay, if you just remember this formula here, then we can just divide it into two separate portions. Dividend plus P1 divided by P0 minus 1, okay. We can just write it like that. Dividend 1 divided by P0, this part is called dividend yield, plus P1 minus P0 divided by P0, which is called capital growth rate. Okay, and the first part is dividend yield and capital growth rate. If you remember, we mentioned that there is two ways that we can be benefited from buying a share. Dividend, or in this case, we can calculate the dividend yield and the capital gain, which in here also we can calculate the capital gain in terms of percentage. When we add these two components, it's going to give us the total return. Let's see an example. Suppose you expect Walgreens Boots Alliance, a drugstore chain, to pay dividends of $1.60 per share, and that could be a D1 actually, because you expect to receive, and trade for $70 per share at the end of the year. It means that you are able to sell it at $70, P1. If investment with equivalent risk to Walgreens stock have an expected return of 8.5%, what is the most you would pay today for Walgreens stock? What dividend yield and capital gain rate would you expect at this price? Okay, dividend yield, we know that this is the way we can find it. Dividend 1 divided by P0 gonna give us dividend yield, and P1 minus P0 divided by P0 gonna give us the capital gain. We just replace these things, and we're gonna know that the price that we're supposed to buy is 65.99. There's also another example. Agnes wants to purchase common stock of New Frontier Incorporation and hold it for 4 years. The directors of the company just announced that they expect to pay an annual cash dividend of $4 per share for the next 5 years. Agnes believes that she will be able to sell the stock for $40 and at the end of 4 years. In order to earn 12% on this investment, how much should Agnes pay for this stock? First thing first, always remember to draw the timeline, okay? Okay, see, the dividend that would be received is 4 for how many years? 5 years, okay? And end of for 4 years. And at the end of this 4 years, gonna sell it at $40. Okay, does it look like the annuity? Of course, this is an annuity. You remember fixed amount of income we're gonna receive for the certain number of years. And this is how we find this part, we find the present value of the annuity, which already I've learned it. And this part is just finding the present value of the single cash flow, which we already have learned. Means 40 divided by 1.12 to the power of 4 and the rest. And this is the price we're supposed to pay in order to buy this stock, if you want to buy it. Okay, stock valuation. It's gonna talk about a bit in deeper level, actually, in more details. 4 variations of a dividend pricing model have been used to value common stock. Let's see one by one. The constant dividend model with an infinite horizon. which looks like this part. See, constant dividend model, all the dividends are the same for the infinite horizon. Constant dividend model with the finite horizon. See, dividends are the same, but for the fixed period of time. The other one is the constant gross dividend with a finite horizon, like that. See, there is a growth in the dividend, but for the limited number of years. And the other one is constant growth dividend model with an infinite year. There is a growth, but this growth is going to infinity. Okay, the first one, the constant dividend model with an infinite horizon. See, as we can see here, the dividends are fixed. Then, and this model looks like the perpetuity, which we already have learned it. Nothing new up to here for you guys. Okay, assume that the firm is paying the same dividend amount in perpetuity. And how to find the perpetuity? Perpetuity was like this. The present value was the cash flow divided by the required rate of return or interest rate. See here. Okay, let's see an example. Let's say that the peak growth company is paying a quarterly dividend of 50 cents, and has decided to pay the same amount forever. Okay, if Joe wants to earn an annual rate of return of 12% on this investment, how much should he offer to buy the stock? First thing first, the dividend are paying quarterly, but the required rate of return is annual. Then we need to do some adjustment. Okay, dividend is quarterly, we have it here. But for the required rate of a return, the 12% should be divided by 4, which we're going to get 3%. Then 0.50 divided by 0.03 going to give us 16.67. That's the intrinsic value of this stock. The constant dividend model with a finite horizon. The second scenario, okay? The timeline looks like this. And of course, okay, there is two parts in it. Let's see. Assume that the stock is held for a finite period of time and then sold to the another investor. See, means first we're supposed to find the present value of all these dividends, and also when we sell it off, then we need to discount back the sell price. Constant dividends received over the investment horizon, price estimated as the sum of the present value of an annuity, constant dividend, and that of a single sum, the selling price. Similar to a typical non-zero coupon corporate bond. Let's see an example. Let's say that the peak growth company is paying an annual dividend of $2 and has decided to pay the same amount forever. Joe wants to earn an annual rate of return of 12% on this investment and plans to hold the stock for how long? 5 years, finite, with the expectation of selling it for $20 at the end of 5 years. How much should he offer to buy the stock at? Okay, see, as we already have learned, there is two parts. Present value of dividend stream over 5 years, that we can use the annuity formula. And here also there is just single cash flow. The sale price, we can just discount it back to the present time, which at the end we're gonna get $18.56. Okay, the third scenario is the constant growth dividend model with an infinite horizon, known as Gordon model. You need to know that when you hear the Gordon growth model, this is what we are referring to. The constant growth dividend with an infinite horizon. Estimate is based on the discounted value of an infinite stream of future dividends that grow at a constant rate. Okay? See here. Okay, we have dividend 1, isn't it? Then we suppose discounted back, dividend 2 discounted back, dividend 3 discounted back, all until whatever dividend that we have. But we know that there is a growth in a dividend. It means that when we have a dividend 0, then based on dividend 0, we can find a dividend 1. How to find a dividend 1 is here. Dividend 1 is dividend 0 multiplied by the 1 plus g. Okay? And we continue the same story. How to find the dividend 2? The dividend 2 is dividend 1 multiplied by 1 plus g. Okay, we can replace the dividend 1 with this formula that we already have here. Would be like this. Dividend 2 would be dividend 0 multiplied 1 plus g to the power of 2. Okay? That's why in here you see that dividend 0, but the power here is keep changing. That's the logic behind. And of course, we discount back all these dividend to the present time in order to find the price or intrinsic value of the stock. Okay, when we summarize the previous formula, we're gonna get this formula. Okay, we can write it in two ways, based on dividend 1 or dividend 0. If you just write dividend 1, it would be like the dividend 1 divided by r minus g, or we can just simply replace the dividend 1 by d0 multiplied by 1 plus g divided by r minus g. It depends that we are given the d1 or d0. Okay, example. Let's say that the pig growth company just paid its shareholders an annual dividend of $2. Just paid. See what he's saying? Just paid means it is dividend 0. And has announced that the dividends would grow at an annual rate of 8% forever. G is given to us. If investors expect to earn an annual rate of return of 12% on this investment, how much would they offer to buy the stock for? Okay, it's quite easy because in this case D0 is given to us, then we need to do some adjustment. Why? Because the formula is D1 R minus G. Then, okay, how to find D1 is D0 multiplied by 1 plus G, which we're gonna get 2.16. And R minus G also is this amount at the end. The price is 54. There's also another example that you can just go through by yourself. Okay, the fourth model is constant growth dividend model with a finite horizon. See here that there is a growth in our dividend, but for the fixed number of years, and after the fixed number of years, of course, we can sell the share. And this is see the present value of sale price, and this part here is the present value of all these dividends. Investors expect to hold the stock for a limited number of years. Companies' dividends are growing at a constant rate. Following formula is used to value the stock. Okay, there's an example. The quick fix company just paid a dividend of $1.25. See, it's saying that just paid means this is D0. And analysts expect the dividend to grow at its compound average growth rate of 10.72% forever. If you plan on holding the stock for just 7 years and you have an expected rate of return of 14%, how much would you pay for the stock? Assume that the next owner also expects to earn 14% on this or her investment. Okay, we can do we can solve this question with two methods. Method 1, method 2. Method 1, use the constant growth finite horizon formula, and method 2, use the Gordon growth model. G is constant forever. And both investors have the same required rate of returns. Let's see. This is the first method. Then, okay, we have all the ingredients. The only thing that we just need to replace it. D0 is given to us. This is my G also is given to us. R is given to us. And N also is for 8 years. Okay. Then we simply can find the price. We just replace all this inside and we're gonna get the 42.19. Okay. Okay, the other method is using the constant growth model, Gordon growth model, that if you remember this one, this was the formula, yeah? D1 divided by R minus G, which we have all the ingredients, we just plug in, we're gonna get the same answer. Okay, but what if the dividend that we are paying is keep changing, is not fixed, the growth rate is not fixed? For some years, there is a growth in the dividend, in some years there is a decline in the dividend, in some years no dividend, all these things. What to do? Non-constant growth dividends. The above four models work if a firm is either expected to pay a constant dividend amount indefinitely, or is expected to have its dividend growth at a constant rate for long periods of time. For most firms, the dividend growth patterns of most firms tend to be variable, making the valuation process complicated, of course. However, if we can assume that at some point in the future the dividend growth rate will become constant, we can use a combination of growth model and present value equations to calculate the price of combination. As you can see, we need to be a bit creative and gonna combine all these concepts that we already have learned. Let's see this example. The rapid growth company is expected to pay a dividend of $1 at the end of this year. See, you're gonna receive $1 at the end of year 1. Thereafter, the dividends are expected to grow at a rate of 25% per year for 2 years. See, for means from year 1 up to year 3, the growth rate is 25%. And then drop to 18%, means from year 3 to year 4, the growth rate gonna drop to 18%. Before selling at the industry average growth rate of, settling at the industry average growth rate of 10% indefinitely, means after year 4, the growth rate forever would be just 10%. If required a return of 16% to invest in a stock of this risk level, how much would you be justified in paying for this stock? Okay, let's see. D1 is 1, G1 is 25 for 2 years, G2 is 18%, N1, and okay, the period is just 1 year, and after year 4, the growth rate is 10%. Okay, let's see how to find the dividends first. Step 1. Calculate the annual dividends expected in years of 1 to 4 using the appropriate growth rate. Okay, D1 is already given to us. How to find D2? D1 multiplied by D1 plus 25. This is a growth rate. It would be the 1.25 is the D2. How to get the D3? D2 multiply the growth rate, 1.25 is 1.56. And for the D4, Okay, D3 multiply 1.18. Why? Because after year 3, the growth rate is just 18. Okay, step 2 is calculate the price at the start of the constant growth phase using the Gordon model. Okay, we need to find the price at year 4. Here, isn't it? We need to find the price at this point. Means this price relates to all these dividends after year 4. How to find it? Price at year 4 is equal to dividend of year 5 divided by R minus G. Means D4 multiplied by 1 plus G divided by R minus G. That's why you here see that P4 is and D4 multiply 1 plus G is D5 actually, yeah? Divided by R minus G. We just plug in the number and this is the P4, but we still need to see, we need to bring this P4 to the present time. Step 3. Discount the annual dividends in year 1 to 4 and the price at the end of year 4, P4. Back to year 0 using the required rate of return at the discount rate and add them to solve for the current price. See D1 divided by 1.16 plus 1.25 divided by 1.16 to the power of 2. This is just using the single cash flow. That, if you remember, PV was FV 1 plus R to the power of N, which FV is the dividend for us in this case. And when we're putting all this together, we're gonna get $22.44. Okay, of course, no model is a perfect model, and dividend discount model also has its own shortcomings. Let's see some of these shortcomings. Need future cash flow estimates and a required rate of return. Therefore, difficult to apply universally. Yeah. And we are not sure actually how much dividend would be paid, how much would be the growth rate of the dividends, and how much the stock could be sold. Theoretic dividend patterns, long periods of no dividends, declining dividend trends, all has an impact on our valuation. Need a pricing model that is more inclusive than the dividend model. One that can estimate expected returns for stocks without the need for a stable dividend history. That's why researchers try to come up with other models in order to value the stock. The capital asset pricing model, CAPM, or the security market line, SML, which will be covered in chapter 8, is one option. SML can be used to estimate expected returns for companies based on their risk. The premium for taking on a risk, or beta, or the market risk, and the reward for waiting and not on their historical dividend pattern. See, there are other models than the dividend discount model can help us to find the value of the stock based on the risk that they undergo. Okay, up to here, whatever we learned was related to the ordinary shares or common shares. From here, we're gonna see something related to the preferred stock. Okay, let's see the definition. Pays constant dividend as long as the stock is outstanding. Okay, the previous one, the ordinary share, if the company wish to pay the dividend, shareholders gonna receive dividend. But what if the company doesn't pay any dividend? Then no one gonna receive dividend. But under the preferred stock, companies obliged to pay dividends. Yeah, typically has infinite maturity, but some are convertible into common stock at some predetermined ratio. Means you are given an option that you can convert it to the common stock. have preferred status over common stockholders in the case of dividend payments and liquidation payouts. So if liquidation happens, if bankruptcy, anything happens, of course, creditors, suppliers, employees gonna get paid first. Later, the preferred stock gonna get paid, and any residual gonna go to the common or ordinary stockholders. Dividends can be cumulative or non-cumulative. Means that there is an option that if the company doesn't pay dividend, then if it's cumulative, later gonna pay. But if it's not cumulative, then the company not gonna pay any dividend to the preferred stockholders. To calculate the price of preferred stock, we use the present value of a perpetuity equation. Actually, it's nothing new. If you just see the pattern of the dividends, it looks like the perpetuity concept. That's why in order to find the value of the stock, preferred stock, we just divide the D1 by the required rate of return. See an example. The Mid-American utility company's preferred stock pays an annual dividend of 8% per year on its par value of $60. If you want to earn 10% on your investment, how much should you offer for this preferred stock? Okay, then we need to find the dividend first, which is 0.08 multiplied by the par value of 60 is 4.80 divided by required rate of return, which is 10%. Then the price of the preferred stock would be $48. Okay, calculation finishes here. Then we're gonna go to the concept of efficient market. Efficient market has two or sometimes three forms: operational efficiency, informational efficiency, or sometimes the third category is transactional efficiency. Market in which security prices are current and fair to all traders. And we assume that transaction costs are minimal. An efficient market hypothesis is quite important concept, and this is one of the assumptions behind many finance theories. Okay, what is operational efficiency? Speed and accuracy with which trades are processed. Yep, when we are buying and selling the shares, the speed and accuracy of the price matters. Otherwise, the market would be inefficient, operationally inefficient. Ease with which the investing public can access the best available prices. The New York Stock Exchange Super computer system or the Nasdaq's. Match buyers and sellers very efficiently and at the best available price. Therefore, definitely very operationally efficient markets. Okay, informational efficiency. Mostly when we talk about efficiency, market efficiency, we are referring to the informational efficiency. That's the biggest difference between the developing and developed financial market. Under the developed financial market, we assume that all the available information, historical information, publicly available information, or insider information is accessible to all the shareholders. Market is transparent. But under the developing financial market, not all the information is available to the shareholders. Speed and accuracy with which information is reflected in the available prices for trading. Under the informational efficiency, we assume that if there is any news, no matter it's positive or negative, immediately would be reflected in the price of a share. If there is a positive news, then the price of a share gonna go up. If there is a negative news, the price of a share gonna drop immediately or with a minimal delay. That's the meaning of efficiency. Informational efficiency means all the available information would be reflected in the price of a share. Securities would always trade at their fair or equilibrium value in the efficient market. Diverse information. Financial economists have come up with three versions of efficient markets from an information perspective. Weak form efficiency, semi-strong form efficiency, and strong form efficiency. It means that whenever we talk about efficiency, we can categorize it in these three categories. These three nested forms make up what is known as the efficient market hypothesis, EMH. Informational efficiency, a weak form efficient market. When we refer to the data or information, we can have historical data or information, we can have publicly available information, and we can have insider information. Weak form efficient markets, current prices reflect past prices and trading volume. Technical analysis is not useful. What does that mean? It means that if there was any news, good news or bad news, already that the impact of that news has been reflected in the price of a share. It means that the current price that we have is consists of all the past happenings and informations. What does that mean? It means that by analyzing the past information, past prices, we should not be able to find any constant abnormal profit or return actually. Okay, why? Because all the prices, all the information, past news already have been reflected in the price of a share. If we can find some pattern in the past prices, it shows that all the past prices all the past information has not been reflected in the share price. Then it says that market is weak form inefficient. Semi-strong form efficient markets refers to the publicly available information, means those information that are published in the company's statements, which is available to everyone all over the world actually. Means that the moment that the company publishes its statement, any form of statement, those information would be available to everyone. And if those information or data are a good news, good information, positive information, then the price of a share gonna go up. If it's a bad news, negative news, the price of a share gonna drop. Okay. If we are in the semi-strong form efficient market, then by analyzing the publicly available information, we are not supposed to be able to find constant abnormal return. Why? Because we assume that all those publicly available information has been reflected in the price of a share. If by analyzing the publicly available information we can make a constant abnormal return, then it shows that market is semi-strong form inefficient. Current prices reflect price and volume information and all available relevant public information as well. Publicly available news or financial statement information not very useful. Okay, and here is strong form efficient markets. Refer to the insider information, those information that is available to the CEO, CFO, COO, and all the employees. But if we assume that market is strong or efficient, no matter you are a shareholder in which part of the world, or if you are employee, or if you are the CEO of the company. Everyone has access to the same level of information. And this is the ultimate goal of any financial market: transparency. Current prices reflect price and volume history of the stock. All publicly available information, and even all private information. All information is already embedded in the price. No advantage to using insider information to routinely outperform the market. Jury is still out. Evidence is not conclusive. Okay, that's the end of the lecture. From here onward, there are some questions and additional problems that you can do it by yourself.